Welcome back. This is our fourth video in a series of videos that we're looking at an example question called James Bond with respect to looking at the concept markup and margin. Now, in our previous video, we would have gone ahead and we would have calculated our gross profit by finding out what our margin was. So we converted our by calculating what our markup was, by converting our margin to our markup, and we found that as a fraction, because remember, your margin or your markup can be expressed as a fraction or a percentage. So as a fraction, our markup is 30 on 70 or 3 on 7. And then we use that to work out what our gross profit was by taking that fraction and multiplying it by the cost of sales, which were $91,700, which gave us a gross profit of $39,300. And we said from previous accounting teaching, we know that our gross profit would be our sales minus our cost of sales. So we said, well, if that gives us our gross profit, it will be safe to say that we can flip the equation, and then our sales would be our gross profit plus our cost of sales. And we recognize then that our sales figure came out to $131,000. So we now have sales of $131,000. So since we know how much money how much sales revenue we receive, what we can do now is to work out our receipts from our debtors, or how much money we receive from our credit customers. So we can calculate that figure. And how we are going to do that, we can do the T account for the control account, T account now if we wanted to, but what we can do is that we can then just take our sales and minus our closing debtors from that figure, and it would give us what our receipts from our debtors would have been. Remember, we would have also stated that in lieu of the control account, you can do an adding and subtracting method. You don't always have to draw up a control T account to work out certain figures. You can still use the adding and subtracting method, and that is what we are going to do here. We are going to calculate our receipts from our debtors. That's what we're going to calculate. And how we are going to calculate it, we're going to take our sales that we just worked out and subtract our closing debtors, because if you did a control account, remember that in this particular question here, in this question, you don't have any opening debtors. If you did have opening debtors, you would add them to your sales, and then you would subtract your closing debtors, which would then give you the receipts from the credit customers. But we don't have that. So what we do is just subtract our closing debtors from our sales figure, and that will give us how much money we receive from the credit customers. So closing debtors minus our sales minus our closing debtors will give us our receipts from our credit customers. So basically that would be $131,000 minus our closing debtors, which were $12,400. So this is our closing debtors here, $12,400. So minus $12,400, which would give us, so $131,000 minus $12,400 give us closing debtors of $118,600. So our closing debtors, our receipts from our debtors, are $118,600. So now we know that we can put it in our account here, $118,600. So we know our receipts from our debtors is $118,600. So now let's see if we can calculate our purchases so that we can then work out, if we work out our purchases, then we should be able to calculate our payments to our creditors. And that then would allow us, we will no longer have three missing figures, because right now we dealt with one, so we only have two. But when we find out our creditors, the payment to our creditors, we will just have one missing figure, and then we can use this account to work out our drawings. Okay, the question is a bit complex. We have other questions that is not as complex as this that you may practice as well. So we're going to calculate purchases. So to calculate our purchases, and we're taking this again from our income statement format. Our purchases, remember your income statement, your opening inventory plus your purchases minus your closing inventory will give you cost of goods sold. So I will say that again. From your income statement, your opening inventory plus your purchases minus your closing inventory will give you cost of goods sold. So we're going to flip that equation. So if we flip it, we will say that our purchases is equals to our cost of goods sold or cost of sales plus our closing inventory minus our opening inventory. Right? So if that is so, then our purchases then, so our purchases will then equals to $91,700. This is our cost of sales plus 21,200, which is our closing inventory that is given to us here. Closing inventory 21,200, and our opening inventory is $5,000. So 21,200 minus $5,000. Okay, so let's see how much that is. 91,700 plus 21,200 minus 5,000. That gives us our purchases. Hope I didn't. Yeah, I made a mistake. 91,700 plus 21,200 minus 5,000 give us purchases of $107,900. So our purchases are $107,900. So since we know our purchases, we can calculate our payments to creditors. And we can do that again by taking our purchases and subtracting our closing creditors. Now remember, if you had opening creditors, you would add your opening creditors to your purchases and then subtract your closing creditors, and that would give you your payments. So let's see what we paid our creditors. So it's our purchases minus our closing trade creditors, which is $107,900 minus closing creditors. Let's see what they were. Our closing trade creditors is $4,900. $4,900. So let's see what our payments to our creditors would be. 107,900 minus 4,900. Our payments are $103,000. So now we know our payments to our creditors. So we can go into that here in our bank account, 103,000. And since now we only have one missing figure, we add the debit side of our bank account, and that came to $148,600. But the credit side of our bank account is only $142,800. So to work out our drawings then would be 148,600 minus 142,800, which gives us drawings of $5,800. So now we know our drawings are 5,800. So we know a lot of information now. We know what our drawings are for our statement of financial position. We know our sales, so we can do our income statement. We know our purchases, so we know our sales, we know our purchases. We can do our income statement. We have lots of information. So that is basically our step 3 that is completed by using the markup margin method rather than the control accounts method. So the step 4, step 4, which you usually have to do, is to make adjustments for accruals and prepayments. So let's see in this question if we have any accruals and prepayments, and most likely we will not, because they said that the expenses were paid on a cash basis. So they basically pay the persons when they had to pay them, so they don't have anything outstanding. So we're seeing here we don't have anything outstanding at the beginning or prepaid, because obviously the business now start. At the end, we don't have any accruals or prepayment. So in this particular question, we don't need to make any adjustment for accruals and prepayments. So no adjustments were necessary. Then we can go on to our step 5, which we calculate allowance for doubtful debts, depreciation, etc. Right? Any other thing you need to calculate. So in this question, we don't have any allowance for doubtful debts to calculate, because they didn't mention anything about allowance for doubtful debts to be created. But what they mentioned is that we have fixed assets at the beginning of $8,000, and they said in addition to depreciation, so that means they have some depreciation going on. And then here they said us, let's ignore that one. They have it says the depreciation rate for a fixed asset was 10% on straight line. So here they have the depreciation rate. So they give us a rate for depreciation, 10% of the asset straight line, and our asset is $8,000. So let's calculate the depreciation for our fixed assets. So depreciation on fixed assets would be $8,000 times 10%, and that gives us a depreciation of $800. So we know our depreciation. So we have lots of information now. We know our sales, we know our purchases, so we can do our income statement. We know our opening capital. We know what our drawings are. We have other information with respect to the balance sheet, so we can do that as well. So what we're going to do when we come back in our next video, what we're going to do, we will be doing our income statement and our balance sheet. So that's what we're going to be doing in our next video.